All right, and here we are. We're back. Another very special edition. Today is all about money and the monetary system. Oof. Here we are. I'm Kevin. You know me.
I'm Eva.
I'm Thomas.
And we're gonna talk about money today. So I think the best way to understand what money is to picture a world without it. Right? So what does a world without money look like? You guys want to weigh in?
A lot of bartering.
Bartering. That's a good word. What do you mean by that?
Trading between people.
Trading between people. But what's important to remember if we're talking about a bartering society, the trading can only happen if both of us want what the other person has.
Yes.
So if you have carrots and I have apples and I want tomatoes, we're not going to barter. You know what I mean? And they call that, I believe they call that the coincidence of wants is what's required if you are in a bartering society. So clearly, that's not ideal, right? You don't just want to have a society where people trade stuff for stuff. If they could instead trade what they have for whatever they want, like some amount, I'll give you these 10 carrots for some amount of whatever I want, equivalent to 10 carrots. Well, that's much more useful than something I may or may not want. Does that make sense?
Yeah. And there will just be so much more volume of trade.
Yeah. So you can definitely trade more, right? If you don't have to just happen across someone that has what you want and is also willing to take what you have. Like, that's not an easy situation to be in. So what is money? Well, it's the assets that people use to trade goods and services, essentially, right? I mean, more or less. And it can really be anything. If everybody agrees that it has value and you can trade between it. So I really like an example from Micronesia, which is in the Pacific. There were cultures that instead of using coin money or paper money that's common in Europe, they used stones. And specifically the stones were cut into these large ring-like shapes. And they were as big as like 4 or 5 feet wide. So these giant rocks. So
not very convenient.
Yeah, certainly not very convenient. But if everybody agrees that it has value and you can sell your cow for a giant, they were called rye stones, and you could, roll it out in front of your house, and now you've got stones, you know what I mean? And people are going to look up to you. Yeah, you have this medium of exchange. My favorite story with this is allegedly a boat was carrying some of these stones and sank between these Micronesian islands. And the rye stone sank to the bottom of the ocean, but the owner didn't lose its value because everybody still agreed that the stone was there. So they still traded the stone, just agreeing that now it's Thomas's stone. Oh, now it's Eva's stone. Because they traded cows for stones and told everybody. But even though they didn't have to physically change hands. And I think that's really funny, really interesting. Precursor to something we kind of do nowadays,
Huh.
But yeah. So what do we want it to be? We want it to be like, what do we want our money to be? We want it to be like a medium of exchange. You can trade your goods and services for this in-between kind of thing that can get you other goods and services. You want it to be a unit of account. So you want it to be able to count up how much a business makes. Count up how many
stones you have.
Yeah, how many stones you have. And you want it to store value, right? So if you want to trade your carrots for cash today, you want to be able to spend that money At least, obviously inflation exists, but like to some degree you want it to store value. So here's a trivia question for our non-economist. Do you know what the gold standard is?
I know that we used to have a silver standard. No, they had to pick between silver and gold standard, and it was just like what was going to back up paper money?
Yeah. So that's true. There was some debate, especially in the late 1800s, over whether to go to the silver standard. But all the gold standard means is that you back each dollar with the equivalent weight in gold, like an equivalent dollar amount of gold. And that way you can't have more money in the system than you have backed with like physical commodities. And those are called commodity monies, right? As opposed to fiat money, right? Fiat money. That's the kind of money where you just decide how much there is. The government, if you look on your dollar bill, it says backed by the full faith and credit of the United States government. And that's what it's backed by. It's not backed by a physical commodity like gold or oil. It's backed by the faith in the government, which may seem a little ethereal, but it helps us do some really important practical things in the economy, right?
Printing more money.
Like printing more money. Yeah, sure. But maybe that's a useful tool to have
No, I
in our
didn't mean it in a
toolbox.
bad way.
Yeah.
I mean, we just had a massive stimulus.
Yeah.
I mean, we don't know. I mean, there's so much debate on what could possibly happen, but it did seem that people needed money, and they were. I mean, if you had to go mine gold before you could. I mean, what would you do if you're on the gold standard and you literally? It would definitely be cool though, because if you're on the gold standard, you can literally take $100 bill to a bank or to somewhere and get that equivalent in gold, right? It's somewhere. I mean, I don't know if it would work exactly like that, but
That is a thing. That is definitely a thing that you could do. And the U.S. went off the gold standard, I believe, in the 70s. I think Nixon did that. I might be wrong about that, but I'm pretty sure. Mm-hmm. But they call it fiat money. That's what they call it.
So we used to have commodity money, and now we have fiat money?
Mm-hmm. Yep. So there is like an amount of US dollars in circulation, right? If you add it all up, there is a number. We call that number, anybody know? Money supply.
Oh.
Money supply. And there's different ways to measure it, and there's different ways of defining it. Just kind of like you can picture how unemployment had multiple definitions depending on who you want to include. Money supply is going to be very similar. It's going to have multiple definitions depending on how much you want to include, what all is going to count. And the reason that it's not as easy as just physically counting $1, $2, $3, $4 is something that we've actually already mentioned in class before, something I find really interesting. It's called fractional reserve banking. It's lots of fancy words. Either of you guys know what that is?
it's where banks have to hold a certain percentage of the amount that they loan out on, like, in physical cash at that bank. Is that right?
Yeah. So it's we don't call like the requirement the fractional reserve banking. We just call the system the fractional reserve banking.
Okay.
But all it means is that if you go to the bank and you give them $1,000 in savings, they don't just leave it in the safe. They loan it to people, and they keep 5-10% of what you give them on hand in the safe or in their cash drawers, right? So they have some of the money, but obviously they're loaning it. They're using it to make more money. So it gets kind of interesting, right? So say I go to the bank, I deposit my $1,000, and they keep 10% in the bank, and the other 90%, the other $900, they loan to Eva. Okay. Well, Eva goes and she spends $900 on whatever she needed the loan for, say a car, and then the guy that sold her the car goes and deposits that money in his bank, that $900, and then 90% of that gets reinvested into Thomas, And you guys can kind of see how this money gets recycled and reused. And every time somebody else is borrowing on it, the effective money supply is growing. Isn't that so fascinating? The way we do our banking is how we decide what the money supply is, and effectively. We can go count up all the physical dollars, but if you're thinking practically, this is the same as a physical dollar, right? So, do you guys think that that's a good thing? Fractional reserve banking?
It has its positives and negatives, for sure. Positives in that, like, it clearly allows a lot of people to, like, gain liquidity and get investment fast. But if there's large uncertainty and a certain percentage of people go to a bank, then you have a bank run. And that's why you want to be the first one there. Because there's a lot of other people's money in there. So even though it might not be yours, if you have $1,000 to pull out and you're the first one, then maybe you'll get that 1,000. But if you're the 10th person there and the bank runs out of money, I mean, well, what do you do?
That's definitely really true. And if you don't know what we mean by a bank run, I'll put in a YouTube link about bank runs in the comments. But all it is what Thomas is describing, where everybody goes to the bank to try and get their money out at the same time. And it's dangerous, right? So it's not a problem as long as everyone has trust in the system.
Right.
And if everybody is not going to run up to the bank and take out all their money tomorrow, then it doesn't matter. Right. And the bank can even handle, at any given time, 5% of people showing up and saying, I need my money back. You know what I mean? But they can't handle everybody doing that.
Right.
And that's how banks can fail. But we can't talk about the money supply and fractional reserve banking without talking about a giant government body that's very influential and very interesting. Of course, we're talking about
the Fed.
The Federal Reserve, also called the Fed. The Federal Reserve determines our monetary policy. And all we mean when we say monetary is talking about money. So if it has to do with money, it's monetary. And we contrast monetary policy, which is our policy related to money and the money supply and interest rates, stuff like that, with fiscal policy, which is, we're talking about budgets and stuff that Congress passes. So fiscal policy is done by elected officials in Washington and Frankfurt and various other places for sure. But monetary policy is executed by an unelected board called the Federal Open Market Committee, right? FOMC. They're interesting folks, mostly PhD economists that sit down at a table once a month and try and figure out what the best monetary policy would be, whether to raise or lower interest rates, raise or lower reserve requirements.
And it's not all uniform constantly, right? They have like St. Louis and New York and...
Yeah, there are different regional...
So do they still... This is just a question for me. Do you know... I mean, you might not... At one point, like St. Louis would set different interest rates for like their region than like New York would. Or I think the one in California is maybe in San Francisco. I'm not sure. But do you know if that still happens, or is it just like uniform policy?
I think today it mostly looks more like uniform policy, but
yeah,
I don't want to stake my life on that.
I think you're right as well. I just didn't know if you might have a better idea. I think that there's still the boards, but they just all agree to set the same. Like they just agree on the interest rates. But anyway, go ahead. Sorry.
No, you're so good. But yeah, so the reserve ratio, what we're talking about when we say that's that percentage of money that they're going to hold, right? So you walk up with that $1,000, the reserve ratio is what percent that they will save right there at the bank.
And does the Fed set that?
The Fed sets the minimum, right? and then businesses have to be responsible to be obviously above the minimum, and then choose a percentage that is not the, pick something that makes sense for your company. It doesn't have to be the minimum. You know what I mean? I think we mentioned when we discussed recessions, especially the Great Depression, we mentioned that we greatly lowered our reserve ratio requirements, which is not a good thing in the specific situation where they were already low and it was already an economic boom. You don't need to press the gas even harder when you're already going 80 on the highway. But I don't know. That's a bit more nuanced of a debate than I think we need to have today. But the Federal Reserve is an important body or an important institution. Monetary policy is pretty massive as far as its impact on the economy, I would say.
It could be the most powerful. There are many powerful unelected people, but as far as a point, like maybe next to the, I think it'd be difficult to argue that the Supreme Court is not insanely important, but the Fed to just be appointed to something like that is also the amount of power you get, and just an appointment is.
I've definitely heard that the Fed chairman is the second most powerful man in America. And I don't think that that's unfair to say. Is
it like the Supreme Court? Are you appointed for life?
No, you're appointed to terms, and it's I believe it's a 12-member board, the FOMC. I think 7 of them are the 7 regional presidents. It has a lot to do with the infrastructure of the Federal Reserve having different regional banks, and so different bank presidents serve on that board, and you kind of rotate through, as you would. But the chair, him or herself, is appointed by the president, and they can serve for quite a while. A good example, Alan Greenspan, he was in that job for 20 years.
Who holds that position now?
I believe it's Jerome Powell still. I'm going to have to double check that. I know he was.
I'm not 100%, but that sounds right. But yeah, a lot of power.
Yeah, it's still Jerome Powell.
How long has he been there?
I know
since Trump took office, basically.
Okay.
Yeah, 2018.
Okay. Just curious.
But yeah, definitely a very interesting body. I think as far as the most important thing to know, they manipulate the money supply, and that's going to have a lot to do with what our inflation looks like, with what our interest rates look like, and they have a lot of control. And
and they set those inflation targets. They set the interest rates. Well, yeah.
Yeah, they absolutely do. And they achieve those goals with a lot of different stuff. We already talked about one. They set those requirements for reserves. But they also do all kinds of other stuff. The main one, buying and selling government bonds in different situations. That's a big thing. That's how they effectively change interest rates. They call that open market operations. That's probably the main way that the Fed executes policy. But I don't want to get bogged down in lingo and stuff. I think we've had an interesting discussion today.
That was really interesting.
Yeah.
Yeah, I'm getting my master's in econ. I never heard of the Fed, so.
All right.
I'm glad we don't use giant stones.
Yeah.
I'm a fan of our little paper money.
Yeah. One of my professors went there and studied kind of that culture for a while. The professor who knows some of the professors here at Western, he did that. Really cool guy. He had some interesting stories he would always tell about it. But anyway.
All right. Well, thanks for tuning in, guys. Catch you next week.